Hello there, and welcome to the new real estate success model. You are in the Elite 8-Week Academy, and we are in week one right now. So this is Jerry Norton here. I am so excited to be here with you. Welcome to week one training, the old way versus the new way of making money with real estate. And again, I'm just thrilled to be here with you. I'm so excited for you in your real estate journey right now that you're on. If you're part of this 8-Week Academy, then you obviously have gone through my 7-step success plan, and you are now ready to take your real estate business, your real estate investing, and making money in real estate to a whole new level, which is what the 8-Week Academy is all about. So get ready for the ride of your life. Get ready for a life-changing training and getting this business up, launched, scaled, growing, making money for you. And again, I'm just really excited to be here with you. This is probably, of all of the trainings I've done and worked with hundreds and thousands of investors, this is perhaps the most exciting training I have ever put together, and it is the culmination of my, at the time of this recording, 13 plus years as a full-time real estate investor. So let's jump right in, guys. What can you expect in this week's training? We're going to be covering the 4 myths of making money with real estate. We're going to be talking about why flipping is the right solution for you right now today. And we're going to also be talking about the 14 most deadly mistakes that flippers make. And at the very end, we are going to be going over a glossary of real estate terms. So as I go through this training, there will be real estate terminology that is specific to real estate and our industry and what we do. And I will explain that terminology as we go along. But as a quick review, stick around to the very end of this training, and I will go through that glossary. These are terms that you are going to want to learn, get comfortable with, understand what they are, because it is an everyday part of what we do as we build this business. And then also remember that there is a quiz that you can take and that we highly recommend you do take below this module here on the training page. Make sure you take that quiz. It's not hard. It's just to kind of make sure that you're grasping the main takeaways from this training. You will review that quiz probably with your coach. He'll want to review that with you and just make sure that you're on track, you're assimilating and you're learning and you're progressing the way that we want you to, so that you can continue forward through the 8-Week Academy. And it does build upon itself. So as you go through week one and then you do your quiz and you meet with your coach, then we'll unlock week 2 and so on and go through the entire 8-Week Academy training. So real quickly, many of you know my story and my path that I've been on from in real estate. And I want to just kind of briefly, I won't spend a lot of time on this, but I do think it's great to set the stage again and just let you know where I've come from and where this new real estate success model, how this was developed and how this came to be, and why it is so successful in today's environment for you to be successful, for you to build this business and do it the right way. So again, I started my money-making journey in real estate in 2004. At the time I got started, I received, like many of you and like most people, misguided information about how to make money in real estate. I was using dated and old strategies that were not relevant with the current economy and with what works today. And even what works today has been changed, updated, revised. I'm continually improving on that because markets change, right? What works today isn't necessarily what worked yesterday. And that's why it's so important that you align yourself with a successful coach, a successful mentor like myself, who's in the trenches doing the business and knows and is current with what's working, so that you're not following dated information or information that was worked yesterday but not today. Does that make sense? And so that was what happened. What happened for me as I got started in those first several years in real estate is I basically just traded my construction job. Many of you know that I started out as a construction worker doing manual labor. I basically traded that job for a new job in real estate. It was not at all the vision I had for myself when I got into real estate. I was actually working even harder than I was at my construction job. One of the biggest challenges that I almost quit several times was the roller coaster inconsistent income that I experienced in real estate. In other words, I would do deal, make some money, and then I'd go long stretches of time where I didn't make any money, or I even lost money on deals as quickly as I made money because I was doing things the wrong way, I was following the wrong information, and all of the things that have now changed in this new model for making money in real estate that I'm going to be showing you and teaching you and helping you develop. And the biggest thing was it just was not sustainable. I could not continue down that path that I was on and that many, many people are on who follow this old way or misguided information. So how did that all change? I got a mentor, and my mentor was not a real estate investing mentor. He actually was an investor who was a private money investor for me. In other words, he lent money to me for my real estate deals. He was just looking for a passive income as a private investor. But he saw what I was doing, and he had a lot of experience as an executive for a Fortune 100 company. He worked for General Motors. What he did in his career was he set up new plants. So when General Motors went into another country, like Russia or anywhere, a lot of South America, he went in and he was involved in that plant startup and hiring, putting in the systems, getting that plant to become operational. So he was very much an automation guy, a delegation guy, and he looked at what I was doing and he said, man, you're doing things, what are you doing? You're doing it all wrong. So he taught me every great business model requires automation, it requires delegation. He helped me create processes and procedures for producing consistent results. So he took his experience he had and what he did in his career in a Fortune 100 company and helped me see what that needed to look like in what I was doing in real estate. And really more than anything, he helped me focus my efforts on strategic activities, not tactical activities. Big difference, and we'll talk about that. Basically, how to work on your business, not in your business. Big difference. And I really, what happened during that time is I had a complete mindset shift. And I went from this idea of, and this focus of like doing a deal, making some money, to building a business that does deals. Because a business is systematic, and it's consistent, and it's sustainable and repeatable. And so that's what happened with this birth of the new real estate success model. It took over 5 years to create through a lot of trial and error and a lot of testing. But I learned the new way to make money in real estate. And I started doing deals consistently every month. And I started doing deals virtually all over the country. And I started making more money while working less. And what were the results? I developed a proven business model. I now run a multi-million-dollar nationwide business doing deals in real estate all over the country. I travel. I work from anywhere I want. I have financial security. I control my own time between my real estate investing business, my deal business, and my training business. Combined between those two businesses and my brokerage and everything I'm doing, I work less than 30 hours a week. That's my average week. In fact, a really hard, long week for me is 40 hours. But I average around 30 hours a week, many weeks less than that. And it's because I've got now systems and processes in place. I'll be teaching you how to do the very same thing. And I've taught thousands of people, everyday folks just like you, the new real estate success model for making money in real estate. I'm the best-selling author. I'm the nation's leading authority on making money in real estate. And I created the nation's #1 deal management software platform. It's called Flipster. And really, this is it right here. This is an outline. This is a blueprint, if you will. It's basically a process in a snapshot of this new real estate success model. This is the foundation of everything that you're going to be learning and doing with me in this elite 8-week academy. And so it's we'll be breaking this down. We'll be spending a lot of time on this. You can see it says you are in the box at the top. It looks like an organization chart. On the left, we have acquisitions. On the right, we have operations. And then there are functions underneath those. We're going to be going into exactly how to use this model to build out your own real estate business. As part of acquisitions, you're going to be learning my deal acquisition perpetuator formula. And this is finding, analyzing, offering to get deals consistently each and every month. And so we're going to be breaking that down. We're going to be going through that. Before we do, though, I have a question for you. Why real estate? Why are you here? Why is real estate your vehicle for making money in your life, for your financial goals? And really why most people get into real estate is, at the end of the day, it's to build wealth and it's to attain financial freedom. Now, that's usually done in one of three ways. You're either looking to supplement an existing income, or number two, you're looking to replace altogether an existing income, or you're looking to create a new income altogether, right, and do real estate full time. And you're starting from a place where you can create that from new. Many of you want to replace whatever you're currently doing. That's awesome. Or some of you like what you're doing and you're looking to just supplement what you're already doing. Any one of those ways is perfectly fine, and I'm going to help you be successful in doing that. But you need to do it the right way, which is why you're here, obviously. The purpose of the 8-Week Academy and what you're doing with me in particular, specifically, is to create and build a sustainable real estate business. Okay, and we're going to be coming back to that purpose. But that is the purpose of this 8-Week Academy. It's to give you the entire outline, the entire model, blueprint, if you will, from A to Z to how to be successful, how to do this business, and create it in a way to where it's sustainable, it's repeatable, it's consistent every month. Now, you probably know this, but you can focus on building your own dream, or you can help somebody else build their dream, and they'll hire you to build their dream. And that's why many of you are here today. You're tired of helping build somebody else's dream, their business, and you want to now build your own dream, your own business. And nothing is more exciting than waking up every day and building your own dream, building your own business, versus punching into a clock and showing up at a job building somebody else's dream. Because when you work for somebody else, that's ultimately what you're doing, is you're building their dream. Now, really when it comes down to this purpose, this of what we want to accomplish in the 8-Week Academy, I mentioned it's to create and build a sustainable real estate business. Well, how do we do that? Well, first, we focus on the launch phase of the business, which is the framework, right? The structure. If you don't have the right framework, if you don't have the right structure, the infrastructure for doing that, then you're climbing the wrong ladder of success, right? We got to get you on the right ladder. First is launching that. And then once we've got that framework in place, we've got the correct structure, and we build that out the appropriate way, then you can work on scaling, which now that's where automation comes in. Automation, when I use the word automation, I'm talking about systems and processes, the non-human element of the business, right? The robots, the technology side that we can implement. And then we also have the delegation side, which is the people side. There's an element of real estate where we just cannot get away from people. It's about relationships, right? And interestingly enough, in real estate, if you kind of look at what Silicon Valley's been trying to do for the past 20 years, they've been trying to eliminate the real estate agent out of the equation. In other words, why do we need real estate agents? Why do we need people? Let's try to create a automated way of doing transactions for buyers and sellers. They've been trying for 20 years. Well, guess what? There are just as many registered real estate agents today as there was at the peak in 2007. Just as many, and Silicon Valley has not stopped in their vision or their goal of automating the transaction. So what does that mean to us? It means maybe at some point they'll keep trying. I don't know. But really there's a human element to real estate. There's a part of that relationship between buyer and seller that has to happen. And so we know that, and we're going to leverage that as best we can, and we do that through delegation, meaning we have to get the right team players in order to scale and grow our real estate business. It doesn't mean you have to do it. It means we have, but there is a human element. So we're going to use both automation and delegation to scale and grow our business, and you're going to be learning how to do that as well. Okay, so let's dive in here. There are 4 myths to real estate. These are the 4 ways, the old ways of doing real estate, of making money in real estate, that are so prevalent and that have gotten a foothold on almost everyone out there's perception, and it's the wrong information. It's misguided information. The first one is cash flow. So what the myth is that you should focus first on creating passive income or cash flow. In other words, the way to achieve wealth and financial freedom is through cash flowing real estate, which typically means rentals. Or investing in cash flowing assets like rentals. You invest in them until your passive income exceeds your expenses, right? How many of you have heard this? And we've all heard this, right? Invest in cash flowing assets And as soon as your cash flow from those assets exceeds your living expenses, you now have attained financial freedom. So for example, let's say your living expenses are $8,000 a month, and each rental property that you acquire creates $250 a month in positive cash flow. That would mean that if you acquired 32 rentals producing $250 a month, that would be your break-even point. You would be creating now $8,000 in positive cash flow. That $8,000 would then cover your living expenses, and technically you would be financially secure, right? You would have your expenses covered, and you could retire basically and be financially free. Now that's your break-even. So at rental number 33, you would be exceeding your living expenses, and now you would be covering more than that, right? So that's what we've been taught. The second myth we've been taught is, and that's misguided and is the old way of making money in real estate, is to focus on appreciation. So the way to achieve wealth and financial freedom is to buy and hold. Buy and hold real estate. And so let me just go through a number of quotes. Most of these, or many of these, you've probably heard. You've probably bought into, like I did, and you believe, that they are the right way of making money in real estate. Tell me if you've heard of this one. Don't wait to buy land and wait. Right? That's that appreciation idea there, or holding. What about this one? Real estate is an imperishable asset, ever increasing in value. It is the most solid security that human ingenuity has devised. It is the basis of all security and about the only indestructible security. Russell Sage said that's that idea there as well of holding. What about this one? 90% of all millionaires became so through owning real estate. Andrew Carnegie said that. Now that was what got me into real estate. That quote right there said, when I was looking for a way to make money, I said, you know what? If 90% of millionaires did it through real estate, then that's what I'm going to do. Right? But what's the quote? Through owning real estate. Here's the other one. Buy land, they're not making it anymore. Mark Twain said that, right? Landlords grow rich in their sleep. How many of you have heard that one? John Stuart Mill. What about this one? The best time to buy a home is always 5 years ago. That's that idea of holding and appreciation. And this is probably the father of all that kind of changed this mindset or created this mindset over the past 10 years. Real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. Robert Kiyosaki, right? Rich Dad, Poor Dad. He completely transformed mainstream America's view of real estate and investing and cash flow and owning rentals. What about this one? If you don't own a home, buy one. If you own a home, buy another one. If you own 2 homes, buy a third. And lend your relatives the money to buy a home. Which is possibly the worst advice I'd ever heard. What about this one? Every person who invests in well-selected real estate in a growing section of a prosperous community adopts the surest and safest method of becoming independent, for real estate is the basis of wealth. Theodore Roosevelt said that. What about this? Buying real estate is not only the best way, the quickest way, the surest way, but the only way to become wealthy. Now, we'll come back to that, but the third myth is leverage, to use the power of leverage. Right, again, Robert Kiyosaki is a big proponent of this. The way to achieve wealth and financial freedom is to leverage debt to acquire more cash flowing properties. It's to borrow against the equity, right, to acquire more properties. In other words, refinance, take your equity, and purchase more real estate. This is Robert Kiyosaki said, good debt is a powerful tool. Bad debt can kill you. Now, when he says good debt, when he talks about good debt, he's referring to borrowing money, right? Refinancing the equity in a property to acquire then more cash flowing properties. And he says that's okay. That's good debt. We'll come back to that one. Myth number 4 is passive income. Focus on passive income. The way to achieve wealth and financial freedom is to invest in passive income producing assets like rentals. And there's this myth out there that rentals are passive income. Okay? So what's the problem with all of this? Why am I sitting here telling you that this is misguided information? You may be sitting there going, Jerry, this is everything I've ever known about real estate. This is what I've been taught my whole life about real estate. How is this misguided? How is this wrong? Well, let's talk about it. All of these quotes, all of this, these beliefs, these strategies, this mindset, this belief about making money in real estate, it's focused around investing in real estate. Now, it's important we understand what that means. What do you mean investing? The goal of investing is to gradually build wealth over an extended period of time through the buying and holding of a portfolio of investment properties. Investors often enhance their profits by reinvesting any profits into additional investment properties. Investment properties are often held for a period of years or even decades, taking advantage of appreciation. There's that appreciation. While markets inevitably fluctuate, investors will ride out the downtrends with the expectations that values will rebound and any losses will eventually be recovered. Okay, this is now I got these definitions from Investopedia. Now I adjusted them slightly to apply to real estate. But what is investing? Investing, if I were to summarize it, it's long term. It's a long-term strategy, decades. And it's reinvesting profits, meaning you don't see any short-term cash. That's what investing is, and that's what all of these quotes we've been taught, everything that you've been, this misguided information, it's not wrong, it's not untrue, it's misguided because it's focused on investing. So what's the problem here? Why is this a problem? Why is this investing strategy, as I've defined it here, this advice that we're given, why is this a problem? Why is this misguided? Well, first of all, investing, the way that we've all been taught, this old idea of how to make money in real estate, it doesn't provide short-term cash, right? And why is that? Well, remember, your cash flow, any cash flow that's generated from rental properties needs to be reserved. Reserved for what? Ongoing maintenance, capital improvements like a new roof, a new furnace, all of those things. Maintenance would be carpet and paint, kind of things that have to be done every time it goes vacant. Capital improvements are your bigger items, windows, roof, siding, furnace, things like that, water heaters, and just regular expenses like property taxes and, paying a property manager and a placement fee and eviction fees, all of the things that happen with owning rental properties. Any cash you're generated needs to be reserved for those rainy days because they come. They're always there. The longer you own it, the more of those things that come up. Or you have to reinvest your cash flow back into the property or into other properties, right? Remember that idea of the idea of investing is not to realize any short-term gain. If you do realize any kind of profit, you invest that cash into acquiring another long-term rental property, right? Or you reserve it for ongoing maintenance and repairs and capital improvements. The second problem with investing is it takes years and decades of doing just what I said, reserving and reinvesting. Years and decades to see any benefits, right? And many of you, like when I started, didn't have decades. I needed to make money to take care of my family right now, not in years or not in decades. I need money right now. That's why I got into real estate. And that's why many of you are here today. The other problem is it requires upfront cash to even begin, to even invest this way. You have cash for purchasing them. You have cash for repairs. You have down payment money. People say, well, I'll get a loan. Well, even with a loan, you have 20 to 40% down payments are the requirements. And you have ongoing expenses. It requires you to have cash to put into those properties. That's what investing is. It's investing your cash into that asset to realize a long-term gain. And many of you, again, don't have disposable after-tax cash. That's why you're here. That's why you've gotten into real estate, to create disposable after-tax cash, to do things like this. All right, the other problem is with leverage. Leverage is the kiss of death. I cringe when I hear good debt, bad debt. Debt is debt. Because guess what? Whether it's good or bad, you owe that money to a lender, to a financial institution, to an investor, whoever you borrowed the money from. You owe that money. And I get the idea, the concept of, well, it's good debt because you're using that debt to create cash flow. Well, that's only if everything's working correctly. What happens when that property goes vacant and you have to evict a tenant and it takes you 30, 60, 90 days to get the tenant out? And then you got to go in and do fix up. And then you got to put it back on the market and get a new tenant. What happens to all that time that you have no income? That good debt is bad debt now, right? You owe on it, whether you have income coming in or not. Debt, no matter what it is stressful. That's not the kind of lifestyle you want. That's not the kind of lifestyle I want. I don't want to I don't want to owe debt to anybody. If I'm going to own rental properties, I'm going to own them free and clear and not owe anybody any money on those things. This idea of leverage, I think, is the worst advice ever. There are so many people now that have gone out there, maybe you're one of them, and you own 4, 5, 6 rental properties and you leveraged them, you got debt on them, and it is the most stressful thing in your life because you've got those loan payments due. And if 1 month goes by that you don't have cash flow, you're stressing out about making those payments, right? Tell me if you agree with me. Just own rental properties that are financed, and it's stressful. And credit is limited, right? Financial institutions with reasonable interest rates, they will not continue to lend you money. Most traditional, most conventional lending caps them at 10. And 10 isn't enough, especially if they're leveraged, because now you have even less cash flow. So then you got to go into creative ways. You got to find private investors and all these other things that people talk about and that you can do, but it's just extremely more difficult to then continue to grow your portfolio without using credit, without using reasonable financial terms, interest rates, and favorable terms to acquire those rental properties. And even with creative financing, there's usually an element of debt. Even if it's seller financing, land contract, private investors, it's still debt. You still owe that money, right? The other problem with this mindset, one of the myths, is that rentals are passive. Rentals are not passive. Ask anybody who owns a handful of rentals if it's passive. There's nothing passive about rental properties. You have to constantly deal with tenants, toilets, and turnover, right? Even with a property manager, you have to keep an eye on that property manager. You better be following up constantly. You better know exactly what's going on with your rental properties, even with a property manager. The minute you turn your back and think it's passive, you're going to be at a disadvantage. You're going to be taken advantage of, and you're going to find out that your property manager, is finding a way to spend your cash flow every month. There's always a way to spend it if you're a property manager, right? And no offense to property managers. Some of them are great, some of them aren't. Some of them do the best they can. But ultimately, at the end of the day, no one cares about your properties as much as you do. And if you're not on top of it, then you're going to have all kinds of trouble. And so it's not passive. The more you own, the less passive it is. Okay, it's a myth that they're passive. And really, at the end of the day, the bottom line here is investing. That path to financial freedom, it is a path. And I agree with all of those quotes we read. I agree wholeheartedly that real estate is the key, that investing in real estate is the best long-term solution to financial wealth. But it is slow and it is stressful if you go that route. It's the very opposite of why you got into real estate in the first place. And that was the case with me. I owned a whole handful of rental properties. I owned 30-something rental properties. And I was more stressed than ever before. I had less cash than ever before. I was miserable. It was horrible because I went about it all wrong. Right? I was trying to create a new income. I was trying to supplement an income. Then my goal was to replace my income and completely rely on real estate as my means for financial income, which was not what I should have done. When should you invest in real estate? When you have discretionary income, after you've met your day-to-day obligations, your living expenses, with after-tax cash that you have. When you have investment capital to invest that you don't need to see a return on anytime in the short term. When you have decades. That's when you invest in real estate. That's when you do all of these things that we've talked about. It's true, it takes money to make money when you're investing for the long term. Now, I hope that was enlightening. I hope you've got now a new perspective on this. What is then the new way, the correct way to make money in real estate? Well, you first focus on creating short-term cash, right? Not long-term cash, short-term cash, as quickly as possible that you can use to supplement, replace, or create income. That short-term cash will provide you time and financial freedom and lifestyle, right? It will provide you a great lifestyle. Nothing provides a better lifestyle than a padded bank account today, than a cash infusion into your life right now today, to get out of your existing debt, to pay off your bills, to be able to quit a job you hate and do a new career that you love, to pay for your kids' education, to pay for your elderly parents to retire, to travel and have nice things and go on nice trips, right? That's what short-term cash does, especially the way I'm going to show you how to do it. It's going to create a lot of short-term cash. And if you're smart, you'll reinvest those profits, that after-tax income now, that discretionary cash, after you've met your day-to-day income goals and you've provided a nice, comfortable lifestyle, right, with that cash, then take your discretionary income and reinvest it or invest it into long-term investing. Now it's appropriate. Now it's the right time. And so what do we call that? It's important to understand the difference between investing. The opposite of investing is what's called trading in the financial markets. Trading is buying and selling real estate with the goal of generating short-term returns that outperform buy and hold investing. Trading profits are generated through buying at a lower price and selling at a higher price within a relatively short period of time. Now, that's what trading is, a very common term used in the stock market, right? That's that term. You have investing in the stock market, that's long-term, years and decades, and you have trading, which is short-term. Now, in real estate, we don't call it trading. What do we call it? We call it flipping. That's what we call it in real estate, flipping. A real estate transaction that creates a profit in under 12 months. It's short-term. We're in, we're out, we turn a deal, we make a profit. That's called flipping. Now, flipping used to be an obscure term. When I first got started, nobody knew what flipping was, or very few people. Now, thanks to all the TV shows, the reality shows, flipping has now become mainstream, or at least people know the concept, or they think they know the concept of what flipping is. And flipping really is just profiting from the distressed real estate market. Okay, now distressed real estate, that's a key term that you need to understand. 95% of all real estate transactions are sellers who want to sell. Okay, they want to sell and they're going to sell for full retail price. There's 5% of real estate transactions that go on every day where the seller needs to sell because there's a distressed situation. There's what we call a motivated seller, because they need to sell. And there's usually two reasons. Either personal distress, which is usually financial driven. There's a financial distress going on with that property. And or the property is in distress, meaning it's in need of repairs. Now, either one of those, personal or property distress, creates a motivated seller. And get this, a motivated seller will exchange equity for peace of mind. Equity for peace of mind. So your job is to provide a solution. You are in the business of solving problems. So why would a motivated seller be willing to give up equity in a property for peace of mind? Or why? Well, first of all, why would you have a motivated seller? What would cause someone to become a motivated seller that would gladly sell a property with equity for peace of mind? Well, it could be pre-foreclosure. Pre-foreclosure means that they're behind on their payments. The bank has started the foreclosure proceedings, and if they don't get rid of that property in a big hurry, then they're going to be facing foreclosure, which is number two, foreclosure. They could be in foreclosure, so they're motivated. They got to sell that property because they're in foreclosure. They're at foreclosure. It could be an REO. REO means it went through foreclosure. The person lost the home. Now the bank owns it, and they don't want it. They're not in the business of owning real estate. So they want to get rid of that property. They want it off their books. So they're motivated. It could be a property owner who has delinquent property taxes and it's about to go to tax foreclosure. And if they don't get rid of that property, they're going to lose it to the tax auction. Could be probate. Someone inherited a property from a loved one, a relative. Now they don't want that property. They don't want to go in and fix it up or take care of it or rent it or whatever. They just want to get rid of it. They're motivated now because they've got this unwanted property. Could be a burned out landlord. They had a property go vacant. The tenant trashed it. They got to go in and fix it up. They're sick and tired of toilets, tenants, and turnover. And they just want to get rid of that thing and move on with their life. And they will gladly sell that to you with equity at a discount for peace of mind. Could be an absentee owner. That's someone who's moved out of state and they have this unwanted property that they're dealing with and they don't want it anymore. They want to, start their new life and they don't want to rent it out, or they just but there's some kind of issue so they can't sell it and they're willing to give up equity to give it to sell it to you or me at a discount. Could be divorce. Divorce is a huge motivation right now. 1 in 2 people divorce. How much motivated sellers are there due to divorce where they have to sell a property for a settlement, or a property that's got just deferred maintenance? Someone just, the deferred maintenance is built up. There's all these problems with the property and it won't sell to the retail market, to the public, to a homeowner because of the distress and deferred maintenance. Okay, so these are just a handful. There are dozens and probably hundreds of different reasons why a seller would be motivated and why they would sell their property for equity to get peace of mind. So here's just a couple examples. These are a couple of deals I've done. This is a house here that was a probate. So I bought this house. The family, the parent died. There was a handful of siblings that got the property. This thing was in really bad shape. It had uneven floors and just a disaster. So I picked it up for a steal at $175. I completely renovated, added an addition, and did a lot of work on it, and then sold it for $725 to a retail buyer, a homeowner. Okay, but how did I get that deal for such a steal? It was a probate deal. Here's another one. This was an REO. The bank took back this property. You can see on the left there, that's what it looked like. I mean, this thing had been neglected. Who knows how long it was vacant, and I bought it from the bank for $145. I went in and fixed it up, and then turned around and sold it or flipped it, right? Under a year, flipped it for $320,000. This is a burned out landlord. Now, this landlord had 5 properties. I picked up all 5. The landlord had an illness come up in their life. These properties had tenants that weren't paying. They needed evicted. They needed work on them. They had, they had been abused by tenants over the years. And so they needed fixed up. They needed tenants evicted. It was a big hassle. And the burned out landlord said, Jerry, just take these properties for what I owe on them. They have equity. I just want out. I don't want to deal with these anymore. I'm done. So this one here I picked up for $32,000, and I turned around and quick flipped it to another investor, which I'll share with you and we'll talk about that, for $55,000. Didn't do any work to it. Right? So I made $23,000 without doing any fix-up on it. We call that wholesaling. I'll share more about that. My point here, though, is that I got this for a steal with a ton of equity in it from a burned-out landlord. Now, when it comes to flipping, right, there are 2 different methods or strategies for flipping. First is what we call fix and flip, and the second is what we call wholesaling. So let's talk about fix and flip first. Your general definition is you acquire a distressed property with equity from a motivated seller, right? Just like we talked about. And then you're going to add value to the property by making improvements. And you could go from a very light improvement, carpet and paint. You could do an average improvement, carpet, paint, kitchen, baths, new counters, new cabinets, new tile. And you could do an extensive rehab, like the first one I showed you, this one. This one I added an addition and did all kinds of stuff, right? So you could do roof, siding, windows, additions, really do some improvements, very extensive. Any type of improvement from light, average to heavy, that's adding value to the property. And then what you do is that new added value, you've just increased the value of that property. Then you turn around and you market and sell the property to a retail buyer, a homeowner, who's looking for a fully renovated or a like new property. And they'll pay full market value. and you obviously realize a profit doing that fix and flip process. Now, again, the goal is to get in and out of deals in under 12 months. So you acquire the property, you fix it up, you market and sell it, you get a homeowner, and when you close on that sale, that flip or transaction, you realize a profit. So this is an example of this one that I talked about, right? I bought it for $175. This one I ended up putting a couple $100,000 into it, right? But selling it for $725, you can see I made a huge profit on that deal. This one here I bought for $145. I put $95, still a pretty big rehab, into this property, and so I'm all in for $240 and sold it for $320. So made a profit on that one. Now wholesaling, on the other hand, is when you acquire a contract to purchase a distressed property, like a purchase agreement with a seller, and that property has equity from a motivated seller, right? That's the same. But then what you do is you assign or you flip your contract to another investor. And then that investor steps in, they purchase the property, and they pay you a wholesale, or what we call an assignment fee or a finder fee. So they're basically buying your contract to purchase the property. They step in, buy it, and you get paid a fee for that. And that's the example here, right? So again, I bought it for $32. I assigned this property to another investor for $55, and they paid me an assignment fee of $23,000. Because to them, buying it for $55 or paying $55 was still a good deal. There's enough meat on the bone. It's worth about $110 and needs about $25. So there's still equity. They paid me a sliver of the profit, right? A finder fee or an assignment fee, and then they took on the deal. They closed on the purchase, paid $32 and $23 to me, and then they're going to go in and make improvements and flip it or rent it or whatever they do. Now, with fix and flip, the concept here is we're gonna do more work for more profit. And so why? Because with fix and flip, typically there's funding involved. You need to get cash or capital. We'll talk about how to get it, but you need money for the purchase and money for the repairs. Then you have to manage that process of doing the repairs. Whether it's small or light, average, or heavy, you still have to manage that process. Then you got to do marketing and sales to get a retail buyer who's going to then pay you full market value. And your typical profit doing fix and flips on the low side should be around 25, and then on the higher side, 75. Now, obviously, you could do less than 25 and more than 20 and more than 75, but your typical range on deals should be anywhere from 25 to 75,000 profit. So you can see highly profitable to do fix and flips. Now, wholesaling is the idea of doing less work for less profit. Because if you do wholesaling the way I'm going to show you how to do it, the new way of wholesaling, not the old way, there's no funding involved. You don't need any cash involved because you're not the one buying it or fixing it up. Somebody else is. There's no managing because, again, you're not fixing it up. Somebody else is. You do need to do marketing to find cash buyers who will pay you for your contract, right? That you can assign your contract to. And your typical profit on wholesales is anywhere from $5,000 all the way up to $20,000. Now, again, I showed you this one that I made $23,000, but your average deal, your average profit on wholesaling is around 5 to 20. So that's this idea, again, of less work for less profit, whereas fix and flip, making 25 to 75 is obviously a little more work for more profit. But again, considering that you're turning these deals anywhere from wholesaling, which is immediately, zero time, to under 12 months, based on how extensive your fix and flip is, you're still turning deals in and out, short term, making a very large sum of cash, considering other ways of making money, doing flipping, right? Now, one of the things I want to talk to you about here, and this is another part of this entire training here in the Week 1 Academy, is how to do this the right way, how to do this the new way, not the old way. I talked about the old way of making money with rentals versus the new way with flipping, but part of this new way of making money, this model, the new real estate success model, is how to do flipping the right way in today's economy to be consistent, profitable, sustainable, month in and month out. And there are 14 deadly mistakes that flippers make. They follow an old, dated, incomplete way of doing it. The information they have for flipping, it doesn't work in today's economy. Number two, they don't know how to consistently find these motivated sellers. Remember, I said 5% of all transactions are sellers who need to sell. They're motivated sellers. But you have to know where they are. And what most people who do flipping, they don't know how to consistently find motivated sellers. I'm talking everyday motivated seller leads, day in and day out, so that you consistently have deal flow. The old way, and what most investors do, is they don't know how to properly analyze deals. And as a result, they lose money. They don't know how to factor in all of the things associated, including a profit. They misanalyze what a property's worth, what it's going to take to fix up, what they can wholesale it for. They don't know how to properly analyze. So as a result, they get into bad deals and they lose money. You should never lose money flipping. You should always make money. Now, number four, they only make offers on high probability deals and therefore have a very low offer to deal ratio. Offer to deal ratio means how many offers do you make for how many deals you get accepted. And most people, following these old antiquated ways of doing it, they don't make enough offers because they only make offers on deals that they think they have a high chance of getting. And they have a very low offer to deal ratio. I'm going to show you how to consistently make enough offers to get enough deals. And if your goal is to do 5 deals a month, how many offers do you need to make to reach that goal? And we create a consistent model so that you always have deals every single month. Number 5, they don't have a system for finding, analyzing, and offering. Now, this is what I call my deal acquisition perpetuator model. It's a specific, detailed, consistent model for finding leads, analyzing them, and making offers. And we'll dig into that. But most people don't have that. They don't have any kind of organized way of doing that. Number 6, they don't know how or where to find cash buyers to wholesale deals to. Listen, when you learn how to build a cash buyer list, that list is worth millions because you'll have cash buyers that you can wholesale your deals to at any time. And I'm going to show you how to send one email with your deal and have buyers lining up to take it for wholesale fees of $5,000 to $20,000. That's how you want to do this business. That's not how most investors do it because they're following the old way and they don't know how to do that. Now, number 7 is they don't know how to structure what we call a single closing, meaning you go to a closing and you walk out of there with a check and you didn't bring any money to the table. And they don't know how to overcome what's called a no assignment clause. If you have a purchase contract that says no assigning, then what you would technically have to do is close twice. Come to the closing with the money as the buyer and turn around and sell it as the seller, but it would require paying fees and having cash at the table. They don't know how to structure these single closing wholesales with no money involved. I'm going to show you how to do that even with a no assignment clause. Number 8, they don't know how to get 100% funding for their fix and flip deals. They either think they have to put their own money into deals, right? And so I'm going to show you how to do all of these deals, all these fix and flip deals, including purchase and repair money with 100% capital. Other people's money, none of your own money in the deal. Super cool. This is where a lot of people mess this up and they don't do it right and they're very limited on what they can do, or they can't do it at all because they don't have expendable cash to put into deals. Number 9 is to personally do the fix-up work or personally manage subcontractors directly. And so they spend all of their time, energy, and effort doing fix-up work, swinging the hammer, running to Home Depot, or they're personally managing each and every contractor that comes into the property, and they're meeting them every day and they're writing them checks every day and all of that. I'm going to show you how to completely streamline the management process of your fix and flips so that you're not doing any work, you're never lifting a hammer or a finger, and you're not even managing, a dozen or 20 subcontractors to do the work either. And number 10 is they mismanage and hire the wrong contractors. And so their projects get delayed, they go over budget, and it's just a nightmare. Managing contractors is like running a daycare. You want no part of that. And so I'm going to teach you how to do that correctly. Most fix and flippers mismanage and hire the wrong contractors. Number 11 is they over renovate and lose money, right? Over renovate means they do too much fix up and as a result lose money because now they're into the property for too much. Or they under renovate, don't do enough, and leave money on the table. I'm going to teach you how to do exactly the right renovation so that you get the highest return on investment on that flip. Number 12 is they overpay and hire the wrong real estate agent to sell the property. They do it all wrong. I'm going to show you a very neat formula nobody else does that I do, where you'll pay peanuts for a listing agent and you'll get buyer's agents pounding your door to sell your property. It's really, really cool. No one else does it. It's the new way of making money in real estate. It's not how everybody else does it, doing the wrong way. All right, number 13 is they don't know how to negotiate and they don't know how to motivate buyers. And following the new way of doing real estate that I'm going to teach you, you will know how to strategically negotiate and get buyers extremely motivated to buy your property instead of any other properties on the market. Ultimately, when it comes down to it, the 14th most deadly mistake flippers make is they don't have a proven and sustainable business model, a process, because they don't treat this like a business. They don't run it, management, grow it, scale it like a business. You are going to separate yourself from the 99% by following my new real estate success model for doing this business. So I am so excited for you to really dig into this training in this 8-week academy. Remember, the purpose is to create and build a sustainable real estate business, but more specifically, to create and build a sustainable house flipping real estate business. And the goal here is to create, and I want to show you how to build a $1 million business, $1 million net profit per year business. And let me show you what this would take. And when I show you this, I hope this becomes within your grasp. I hope you look at this and you say, I can do that. That's not that hard. Oh my gosh, if I had the right structure and framework and I had the right mentoring, I had the right system in place and the right tools to do this, and I'm willing to put in the effort on my part, this is extremely attainable. Here's what it would look like. Remember I told you that an average fix and flip deal should be between 25 and 75. So let's take the middle there and say 50,000. Now that's obviously a sweet deal. And if you did one fix and flip deal and made a $50,000 profit, and I'm going to show you how to do that on a regular basis. If you did one of those per month, and then you did 3 of those wholesale deals that made on average $11,000 profit. So remember I told you those range between 5 and 20. So let's kind of go in the middle there and call it 11. So you did 3 of those each month. Now remember, you can do more of those because it doesn't take very much time, energy, and effort because you're not buying it, fixing it, or any of that. So you can do a few more of those for the same effort, right? And so you did 3 of those a month. That means in a year, if you would do 12 fix and flip deals at $50,000 a pop, that would be $600,000 in profit. And if you did 3 wholesales a month, that would be 36 of those over a month. Very doable. And that would be another $400,000 to get you to a $1 million profit business. All it takes in this business, guys, to do $1 million a year net profit is 1 fix and flip at 50 grand a month and 3 wholesales at 11 grand a month, and you are there. And I'm telling you, this is attainable. This is not pie in the sky, not totally out there unrealistic. And even if you did half of that, or a quarter of that, or an eighth of that, you would have an amazing business. So, how do we do it? You've got this vision, how do we do it? Following my new real estate success model, where you're at the top of the business, and you run this business as from a strategic role. You're the orchestrator of the business. And you have an acquisitions department that's responsible for finding, analyzing, offering. And you have an operations department that's responsible for either wholesaling it or fix and flipping it. And there's a process and there's a system for each and every aspect of that business. Now, the old way is inconsistent. The old way of doing this business is 1 to 3 deals a year. A year. Not a month, a year. That's what most people do, following old antiquated model of doing this business. The old way is to have inconsistent income. It's to lose money on deals. Make some on some, lose some on some, be inconsistent, go long stretches of time where you have no money coming in because you're in between deals, because you're not consistent. It's to work hard. Most flippers I know, they work really hard. It's a job is all it is. They have no automation, they have no delegation. They're doing everything themselves. Everything. From the finding, analyzing, offering, to looking at properties, to managing contractors, to all of it. Running the Home Depot, swinging a hammer. It's extremely time consuming, takes up all of their time, and they work really hard. They have no lifestyle. They essentially own a job. And their mindset is to do a deal, make some money, do a deal, make some money. And this is how, like I said, most people are following this old way of flipping. And if you did a poll, a survey of fix and flippers out there in the marketplace, this is what most of them do. Now, the new way that you're going to learn is to have consistent deal flow, to do 3 to 5 deals a month between fix and flips and wholesales, to have consistent high income, to do high profit deals, to not lose money on deals, to pick the best deals to keep, those 50K deals, and to wholesale out the rest for $5,000 to $20,000 wholesale fees, to have an amazing lifestyle, to work 30 hours a week or less. So you've got time to still do the other things in life that are more important. And you're going to do that by having really good processes for automation and delegation. You're going to own a system, a business, because your mindset is a business that does deals consistently, profitably, month in and month out. Not to do a deal, but have a business that does deals. Now let me take a minute and give a quick overview of what to expect in the remaining trainings. In the next training, in the week 2 training, you're going to learn the new success model for flipping houses and how to use the 6-figure profit system to do that. So it'll be all about that model and that system and how to then implement that. Week 3 is going to be flipping houses remotely in any market. We're going to talk all about deciding your market, the right market for you. Week 4 is how to consistently acquire high profit deals to flip. We're going to go through the entire deal acquisition perpetuator, everything from finding, analyzing, and offering to consistently get 3 to 5 deals a month. Week 5 is wholesaling deals for quick cash without using funding. We're going to talk about how to structure deals, how to build a robust cash buyer list. Week 6 is going to be all about getting 100% OPM, that's other people's money, for funding fix and flip deals. How to do deals with 100% funding, meaning none of your own money in the deals. And then week 7 is going to be managing and selling fix and flips without personally seeing the property. So everything dealing with fix and flips on the managing them and on the marketing and sales. And then finally, week 8 is going to be putting it all together and how to grow your team, how to delegate, automate as much of the business as you can, and so that you can continue to grow and scale this business and go from 6 figures to 7 figures, right? So that's what we're going to be covering in week 8 and putting it all together. So really excited about this and can't wait to go through this entire training with you. Make sure that you take the time to get on the phone with your coach, you do the quizzes, you go through the lessons, and you do the work so that you can learn how to do this business and do it successfully and earn a 6-figure income doing this business. At the end of this training here, what I want to do here is just take a minute and go through some key terms. Most of these we covered, I think all of these we covered in this training, and this should be a review. This should be, for many of you, maybe you're comfortable with these terms, but just hear me out for the next few minutes. Make sure you're comfortable with all of these terms. In each training, we'll introduce new terms, but you need to be comfortable and familiar with these terms. So a motivated seller is a seller that needs to sell their unwanted property due to personal or financial distress. And again, they'll give up equity for peace of mind. A cash buyer is a term we use for an investor who has liquid funds to buy your wholesale deals, right? When we say that term, whenever you hear me say cash buyer, It's referring to another investor, a fix and flipper or a buy and hold investor that will pay you for your wholesale deals. Now, investing in real estate is using one's cash to acquire properties that yield a return on investment over an extended period of time, usually decades. A buy and hold investor acquires properties, typically rentals, to hold for long term. That's buy and hold investor, if you hear that term. Cash flow is just net profit after expenses generated from the income produced. So if you take a rental property, you take the rental income, subtract it from all of the expenses, right? If you've got debt on it, your carrying costs of that debt, your mortgage payment, your property taxes, your property management fee, all of any kind of routine maintenance and repairs, any expenses, what you're left with is your cash flow. Passive income is this idea of income generated that does not require active participation. It's investing once, doing some upfront work, and then money trickles in without you doing any work or very little work, right? Passive income. Appreciation is an increase in the market value of a property generated over time. So the idea here is that real estate continually goes up. If it has dips, it comes back around, but eventually over time, if you hold it long enough, it will continue to go up in value. That's what appreciation means. Leverage is just increasing your buying power by using debt to finance the acquisition of properties. It's getting a loan, right? That's leverage. Trading or flipping real estate is acquiring and exiting properties for a profit in a short period of time, typically under 1 year. Fix and flip is when you add value to a property with improvements and then resell that property for market value. Wholesaling is when you acquire a contract to purchase a property and then assigning that contract to a cash buyer for a fee. Automation is using technology to create processes, procedures for performing specific tasks. Delegation is using people to create processes, procedures to perform specific tasks. So automation is technology, delegation is people. And okay, so those are our key terms. Oops, those are the key terms that I wanted to cover at the end of this week's training. So again, super excited for you. Make sure you get with your coach. Make sure you do your quiz. Make sure you've gone through this training extensively and you're comfortable and familiar with the entire philosophy we have with the new way of making money in real estate. And starting in week 2, we are going to now do a deep dive into each and every aspect of how to do this business and how to do it the right way using the new real estate success formula and model and not doing and avoiding the old way. That doesn't work. That's antiquated and is unsuccessful. All right, Jerry Norton here signing off, and I'll talk to you soon.